Hello, everyone, and welcome to the third quarter ClearBridge Large Cap Growth Call. I'd like to introduce Peter Bourbeau, who's a co-portfolio manager on the strategy. We do want this to be an interactive update, so please submit your questions online. Peter, while we're waiting for some questions to come in, can we get started with your outlook moving forward? What are your thoughts on the market, considering all of the stimulus we've seen, and how does that affect growth versus value?
Sure. Thanks, Jake, and good morning, good afternoon, everybody. I'm going to be a little bit all over the place when I talk about our current thinking, but I think it's important to put things into perspective. A lot of this is kind of rehashing and reworking what we all know. Right, the two big pillars, obviously, are the fiscal stimulus, right? The products and programs that Mnuchin and team have stood up have saved us from the abyss. But it's also pulled forward a huge amount of consumption, right? I mean, if you look at retail sales, durable goods, the work from home thesis, AutoNation this morning put up their best quarter as a public company. You look at the comps from Home Depot, Costco, and Target. I mean, clearly you're pulling forward a huge amount because of the fiscal side. And then you have the monetary side, right? With rates probably lower forever. Not lower for longer, but lower forever, right? Do we kind of slip into a Japan situation, and time will tell there. But that's been a huge backstop for risk assets, not just equities, but really everything. If you look at credit, commodities, anything on the kind of the risk whip, it's gone parabolic. It's kind of why you see software, parts of software, I should say, the kind of the expensive arm of software trading at multiples, something like 20 and 40 times forward sales, which, we've never seen this before. And I've been doing this for probably 3 decades now. We've never seen multiples on forward sales in various verticals like we're seeing today. It's true that people are learning to live with the virus, right? You're personally dialing up or down your risk tolerance, right? We're doing it all at a very personal level. I think that, and we'll get to this, I know, but if you think about medical breakthroughs and you think about best cases, we're kind of in that 6 to 9 months, Margaret and I, in terms of our forward thinking, in terms of where we think we get the best case all clear. You've got half the economy on life support, and I'm certainly not trying to be glib here, but we've got a lot of structural issues that will not work without government transfer payments, and obviously the ongoing nonsense in D.C. is not helping things, and hopefully we can come to an impasse. But these are things that will have some structural consequences down the road. We haven't seen a credit cycle, right? We haven't seen a recession and the consequences around that in a decade and a half. We don't know what structural unemployment looks like. Recessions have a unique way of exposing companies, and don't kid yourself, they find sneaky ways to cut costs, right? I think there's a social contract with their workers. I think that might end at some point. You also have, and this is the elephant in the room, right? You've got, just on the trading side, you've got factor and systematic products that have massively distorted prices, and this is really at any asset class, right? We look at this in amazement. There's very little return differentiation at the security level, right? Because securities are just grouped into these giant buckets. You look at something as large as Apple, right? It took Apple 40 years to get to $1 trillion, in market cap, and it took 4.5 months to get to the next trillion of market cap, right? That's not normal. This is very atypical behavior, and I think you've got a lot of systematic and factor funds that are influencing this. The one thing that Margaret and I are still amazed with is just the kind of the benign nature in risk. And it's clear, and I think you and I could probably debate this for the rest of the afternoon, but there are, more than a handful of kind of structural issues that we all have to work through. And you look at how well behaved credit and credit default swaps are. You got the VIX on the equity side plumbing new lows, right? Markets are acting like there's no risk, right? There's no bear case. there's this religious trust in the Fed and policymakers in Congress, and we just haven't seen that, and I fully appreciate what low rates can do to risk assets, but to really factor in no risk is something that's a little perplexing to us. And you think about how leadership changes, and I know that the question of growth to value and vice versa is probably going to come up, but the success of a vaccine, I think on the therapeutic side, we've got some really good products and cocktails out there, but the vaccine side, the herd immunity is going to be probably the biggest thing. We talked to a lot of our portfolio companies, and you kind of have two playbooks: one with a vaccine, one without. And this is the ultimate science project, right? It takes usually 10, maybe 15 years to develop a vaccine that you can stand up with a giant body of work and a great safety profile. And here we're doing it in 9 months. So there's obviously some challenges there. But you're going to see leadership change if and when we get a very successful, efficacious vaccine. The leadership from this cycle, I would argue, will not be the leadership in the next cycle, and I think that's worth paying attention to. Obviously, low rates is always going to favor growth, and then you couple that with the fact that in a recession or a huge economic drawdown where growth is scarce, that also factors in with growth, and usually growth is asset light as well. So you don't usually have the kind of the debt servicing and so forth to manage those assets. So that helps the growth aspect as well. I think that probably continues. You're going to see a shift though. You're going to see a shift in kind of inflation forecasts. You'll probably see a shift in rates. Right now I'm looking at the 10-year. It's gone from 55 to 80 bips. You start seeing a percent and a quarter, and I think that you're going to see a radical shift in leadership. So, Jake, that was a long first answer, but let me turn it back to you.
Thanks, Peter, and thank you everyone for submitting questions online. Please continue to do so. The next question I wanted to ask, Peter, is that given this economic backdrop that you just laid out, how are you positioning the portfolio for the recovery? How are you managing your concentrated approach and what has become an increasingly narrow market?
Yeah. Thanks for that, Jake. It's clear that we haven't seen this before, right? I look at our benchmark, which is the Russell 1000 growth, and we've got 3 names that are now 30% of the bench. We've never seen that level of name concentration. And remember, the Russell 1000 growth is a diversified portfolio with 482 names or something like that. So it's something we haven't had to deal with before. What we've always tried to do, and it's served us well for the last decade or so, is to have a fair amount of balance, right? It's a concentrated portfolio in the sense that we're running with a low 40s name count. So we have concentration. Our top 10 are probably 44% of total assets, right? But we're competing with a bench where if you combine tech and communications, you're over 50% of net assets, which puts you in the category of closet sector fund. We're aware of that, right? And we certainly have a fair amount of exposure to some of these big growers. But we have to make sure that we've got a fair amount of balance. We've got a good down capture, and we want to keep that. I think from our perspective, we have to assume, and you have to have a base case, right, when you kind of think about assembling portfolios for the next 5 years, that multiple expansion for the most part has run its course. I kind of mentioned this in the first part, where to see, and this is not an acknowledgement that these are bad companies. You look things like Fastly and Datadog and DocuSign and Snowflake and Tesla. These are wonderful companies. The problem that we're having, obviously, is the valuation that people are ascribing, and what you have to achieve over the next 10 years just to validate current kind of valuation. And that's the part that, like I said, we have to assume those days are over. You'll grow within earnings, and that's fine, but the multiple expansion, I think, is over. And so objectively, Margaret and I are picking our favorites using fundamental and competitive analysis, right? Cash flow, it mattered a decade ago. It matters today when you think about how companies are allocating to make acquisitions and find the best return for their internal dollar. And like I said, you have to assume that we're going to have a version of a successful vaccine. Naturally, it's going to lead to normalcy in inflation, right? Which is naturally going to benefit a wider distribution of equity leadership. Companies and consumers need confidence, and I think that's what we're lacking right now, right? Until that card is flipped on the vaccine side. The thing that we are doing also is looking for some of the more stressed sectors, right? And I think we all can appreciate what they are. But you think about autos have been in a 3-year recession. Retail has been obviously in a terrible place right now. Travel, generally speaking, has been brutalized. So new names for us, Ulta, beauty and skincare is a huge category that we've had no exposure to, and Ulta is one of those category killers, especially with the despecking of department stores. We see the omni-channel approach from Ulta being very successful through the cycle. Uber, obviously a malign name just because of ride sharing. Half their business is doing well, right? And that's the food delivery. But ride sharing obviously is under a huge amount of pressure. That should be part of that recovery trade. Booking, which is an asset-light travel OTA, which is just a tremendous company, should benefit. And if you look at things like Disney as well, which is the company never had pandemic in their playbook, and when you have all global parks, cruise lines shut down, and obviously you've got the live sports aspect of ESPN, which was maligned with a lack of advertising dollars. It's a company that certainly that wasn't on life support, but their EBIT was, and they're going through a huge corporate restructuring. They're spending an awful lot of internal knowledge and money on really their direct to consumer footprint, and they're tearing down a bunch of walls. So we'll see the success there, but that's obviously something that we've concentrated on. Raytheon, another asset which I know we can talk about later, which is half military, half commercial aero, and even things like Visa, right? Visa is a company that we're all well aware of, but you're going to see some permanence in the idea of how transactions get effectuated. Digitization is still early days, and Visa and contactless payments are in its infancy. That should be a great recovery play as well. In the short term, market's very, very overbought, right? The price of failure is extremely high this earnings season. I think we all need to pay attention. You look at Procter's number yesterday, they haven't put up a 9 comp in 20 years, right? And the stock was effectively flat. Texas Instruments put up a monster quarter last night with monster guidance, and it's down 2% today. Even something like a Thermo Fisher, which beat the most aggressive revenue estimate by 1,000 basis points, and the stock is up 2% or something today. So point being is that flat is probably the new up in this earnings season, and the price of failure is going to be exceedingly rough. Again, this is an overbought market. You look at single stock option market, and it's in the single percentage. So we've got a lot of ebullience already kind of baked in. But like I said, we're building a portfolio for the next 5 years, and I would say that the leadership that has gotten us here will not be the leadership that takes us over the next 5 years.
With this diversified set of growth stories, what are your performance expectations, and how do you balance those with risk management when you're going about constructing the portfolio?
Yeah, it's a good question. If you look at the third quarter, and I'm the person that rarely likes to talk about short-term performance, but the gratifying part of of the third quarter is we held up with the Russell 1000 growth, right? We're a much more diversified portfolio. We run with a lot less risk if you look at our tracking error and our standard deviation. And so to keep up with arguably one of the best quarters that's ever been printed, I think it was a plus 13, was gratifying. And again, being underweight tech and especially mega cap tech, you saw things like Grainger work, and you saw things like UPS and Qualcomm, names that were kind of thrown away in this most recent run. These were all huge contributors to performance in the quarter. The one thing that we probably got wrong is how tech was both offensive and defensive in the quarter. That's a rarity. It's something to obviously pay attention to. Certainly, there were some of these digital SaaS companies that will be huge beneficiaries of the permanence of work from home and so forth. On premise is going to get smoked in some cases, but that was a surprising part for Margaret and I, is how defensive and offensive tech acted in the quarter. We have to balance, though, diversification. It's worked over the last 10 years, and when you're staring at a market that's so concentrated, you have to start picking winners, right? We have eliminated our alphabet position most recently, and that's sheerly to increase our active share and to get more touches in names where I think are much more attractive on a risk return. But expect more from us on that front. You know that this is a product that's attracted to controversy, and we've had some success there. So that's the kind of thing that you should expect on a go-forward basis.
Thanks, Peter. Do you look at every growth company the same way when you're conducting your valuation and position sizing?
We don't. This is a market that you look at the Dow, right? Dow is still down on the year, whereas the RLG is up nearly 30%, right? So you've had a huge bifurcation of returns. I mentioned the influence that not just sector funds, but the systematic managed futures and trend followers have had. It's been epic, and then you kind of throw in the retail investor as well, which the journalists have been kind of all over. There's a lot of truth to that. These are giant avenues of disproportionate performance, but we don't look at every growth stock the same. We're very content with a company growing 5 to 8% organically, that's expanding operating margins, and that should trade at a consumer staple multiple. And to identify those and to get a reasonable size position, I think you can compound out for a decade. That happened when we kind of found the IHS Markit name, symbol is info, a couple of years ago. Here's a company that's just stamping out consistent 5 to 8% and growing top line in line, but have some operating leverage and are very strategic and are a rare asset. Those are the kinds of names that can trade at very high multiples. Zoetis is another one. These are not tech names, but these are names that kind of fit what we're trying to do. But we're looking at those in a different lens than we would be a very expensive SaaS company, where you're trying to look at total addressable market, durability of the platform in the franchise, a very, very different set of tools when you do the analysis, and you pay different multiples for that growth rate. But again, just to reiterate, we're trying to have a balance of both. Most of you know that the stable part of our portfolio, right, the kind of the meat and potatoes are 50% of the assets, and you think about Home Depot, a Microsoft, a Visa, that just keep generating huge amounts of cash flow that they can deploy at will. That's always going to be a huge part of the portfolio. We're never going to swing in one direction massively or not.
What is the sector output of this approach, considering that you're diversified and the market has become so concentrated in tech?
Yeah, Jake. So we don't spend an awful lot of time looking at the bench, right? This is a bottoms-up stock picking portfolio. The sector allocations, for the most part, are a byproduct of the buy discipline, and that's gonna continue. Obviously, you have to be aware of these big growers and the relative weighting in the bench. We're 500 basis points underweight Apple. We're 500 basis points underweight Microsoft. We've eliminated our Alphabet, and the idea, simply put, is we're taking our risk budget in areas where we can add value, right? We can add active share. If you like Apple, if Apple really is your number one best idea, right, you have to have 15% weighting just to get paid. That's something this product is never gonna do, right? Amazon is our largest position. It has been for many years, as most of you know. It's a 10% position, give or take, and it's only 150 basis points active. So our active share is something that we're trying to manage, and we're managing it higher, and we're doing it with a kind of a risk tolerance that we're not taking huge single stock exposure there.
Within that discretionary group, how do you think about the secular growth themes of e-commerce and electric vehicles?
We're back to the view that there's a lot of permanence kind of pre and post COVID, and e-commerce is one of those trends. If you're not omni-channel, or if you're not thinking about, if you're a retailer and you're not thinking about the new world, you might as well just fold up your tent. This is going to be something that I think is going to be breathtaking in the size and the scope. It's still early days, and you don't have to play it through Amazon, right? There's other vehicles, right? You look at a boring company like UPS and how they've pivoted from B2C to B2B. It took almost $10 billion worth of capital in the ground and sorting stations and redoing their fleet. But we're kind of here right now, and they've got pricing power, and that's a rarity. So, this is something that has got an awful lot of permanence, and you can do it in ways other than Amazon. And like I said, we spend an awful lot of time talking to our portfolio companies, and it's just amazing how companies have had to rethink, right? Honeywell, which is a company we own in the ESG portfolios, and Grainger. Grainger is, right, it's just kind of a leading MRO, but you've got almost 40% of sales that are online, and you've had to rethink how you get heavy equipment, right, to the job sites and to your project customers overnight. Home Depot has completely changed the way that they've thought about e-commerce, right? Few people do freight like Home Depot does, and that's a competitive advantage for them. Amazon doesn't do freight well, but Home Depot does. So you have to think about where you're good, where you can add value, and it's a tax, right? Dick's Sporting Goods, it's a tax on them. Costco, which is a portfolio company, they don't want to do e-commerce, right? It's dilutive to margins for Costco to do e-commerce. They want you in their stores, but they're forced to stand up and offering and make sure that they are where the customer is. So it's evolving, but that's something that's permanent. And then you mentioned just the thinking on EVs, and listen, whether you like Elon Musk or not, or consider him pathological, that's your decision. What is true though is he has changed the discussion at every single level in how autos are going to be produced in the next 5 to 10 years. And he's obviously struck a chord in the fear of Detroit, but it's not just the auto OEMs, right? You listen to the EMPs and the energy majors. They're terrified of peak oil demand, which is happening probably 15 years quicker than the most expected. But the innovation in autos and kind of the renaissance on what you and I think a light duty vehicle is going to look like is been pulled forward. And you can thank these disruptors, right? Whether it was kind of Bezos and going after parts of technology and commerce and retail, or Elon Musk in autos, but the level of disruption is going to be vast. Another huge theme, obviously, is the end of what we consider normal computing and Moore's law. And I know we're going to talk about this later, Jake, but it's a trend when you think about what NVIDIA is doing on AI and natural language processing. Virtually all major programs, tech programs, are going to be built off of parallel processing and distributed computing. This is early days. Having domain expertise at the silicon level is going to separate a good business model from a poor one. And like I said, we've got a couple leadership companies in there, but it's very early days.
Thanks, Peter. To switch gears here, we've been getting a lot of questions about which areas you've been adding to within the healthcare space. And I know you mentioned vaccines earlier, but where have you found some long-term opportunities?
Yeah, to directly answer the vaccine question, for a large cap growth product, there's not a lot of assets that are investable for us, right? Moderna is going to be too small. Some of the JV candidates that Lilly and Pfizer are working with are going to be too small. And if you think about a vaccine, right, you have exactly one customer, and it's going to be, whether it's the U.S. government or a global single-payer system, you're not going to be able to overcharge for a vaccine. So it's going to be a trump card, no pun intended, but it's going to be a feather in your cap. You're just not going to make an awful lot of profitable dollars along with a huge vaccine because of who frankly your only customer is going to be. We have and continue to see how healthcare is going to evolve with telemedicine, and also how care is going to be delivered at the primary care side. United Healthcare has been a large position for us. It'll continue to be a large position for it. We added to it recently. This is a name that's singularly focused on bending the cost curve. They've got the assets in place. They're going to challenge hospitals and the healthcare system, generally speaking, and they're going to do it for the benefit of their clients. But that's something that we have a lot of confidence in terms of their long-term growth rate. We've got a new position in Alcon, and this is something for those of you that remember the asset a decade ago. It was a cult asset. They are in eye care, both cataract surgery, so the lenses, the implantable lenses there, as well as contact lenses. It's a really neat asset. There's a stat that they keep throwing out that, and I think the number is by 2040, 50% of the global population will be myopic, which means you need some version of vision correction by 2040, right? 50% of the living population. So this is a structural advantage for assets like Alcon. It was bought by Novartis, and subsequent to that, it was spun off. Cataract surgeries have effectively gone to zero as they're fighting for space in ORs with COVID patients, right? So, and that's not specific to Alcon. It was Stryker and Medtronic and others as well. But Alcon should be a huge beneficiary in healthcare. We also, by the way, swapped out of our long-term positions where we don't think you're going to get an awful lot of benefit in the new world. So Johnson & Johnson, not a reflection on a great company. The idea is that we think we could do better, and we sold that asset and swapped it into Amgen, for instance, where we thought the risk return was a lot better. We're still doing a lot of work in healthcare, probably less on the therapeutic side, more on the med tech side. And there might be a couple new names, next time we speak.
Thanks, Peter. You mentioned a number of new names there in the healthcare space. Are there any other areas where you've been able to take advantage of the volatility over the last 9 months to really high grade the portfolio?
It's evolving. The one thing, and this goes back to that comment where we underestimated the durability of tech being both offensive and defensive. Margaret and I thought we'd have more time, and we were not appreciative of putting aside the economy for a second. The fact that the equity markets and really anything that has a level of risk associated with it would rebound as quickly as it did. So in a perfect world, we wish we did more, right? There are great retail assets that we wish we would have bought. Never say never. You know, things like Sherwin-Williams and Starbucks, right? That were trading, you know, at effectively intrinsic value with a huge haircut. You know, these are names that you know, we wish we could have acted a little bit quicker on. We did buy some depressed assets. I mentioned Ulta, which is a new position for us. We've added to our Uber position, which is clearly going to be a beneficiary of some sort of opening. Alcon, I mentioned, even things like Advance Auto, where you had 100% of your stores shut down during the depths of COVID. Right now, you've reopened. You've got miles driven way up. And you're going to see comps in the high single digits, probably worst case, right? And it's a cheap stock. So there's a couple things coming out of this thing that are going to be very, very attractive. But you also have to put a set of assumptions on here, right? What's the durability of work from home? Clearly, there's going to be some permanence. Real estate migrations, right? If you look at Toll Brothers, you look at their highest growth areas, it's in like Provo and areas out west where you're seeing a huge migration out of cities like San Fran, right? You know, what does this mean to building costs, building supplies, right? Is this a permanent tailwind to Home Depot? You know, we think so, and they keep proving it out with really durable comps going forward. So it's not necessarily new ideas. There are names in the portfolio, right? Ecolabs, right? Ecolabs effectively sells sanitation, right, at the consumer level and at the institutional level. And here's a company that is going to have a durable footprint with a huge amount of permanence for a long period of time. So, like I said, it doesn't have to be necessarily new ideas. It's existing portfolio companies that we continue to add to.
Thanks, Peter. We've gotten a number of questions about the mega caps or the FANGs. And I know you mentioned the Google sell earlier as a portfolio construction decision to increase active share. But I think the natural next question would be, how are you covering for your underweight in this mega cap group, and how else can you go about playing innovation in the portfolio?
Yeah. The hallmark of our portfolio companies is a level of innovation and packaging and technology. Even something as obvious as Budweiser, right, which is, I think, controls something like 35% of global beer supply and distribution, right? They're constantly tinkering and innovating at the flavor side as well as packaging, and it's one of the great client, I should say, consumer-facing products with an unbelievable margin structure, where a little bit of help with some reopening is going to go a long way for a company like that. I mentioned IHS Markit, and they sell hard to find market data that influences the insurance companies, the auto companies, financial markets, and they do it better than anyone, and they have a lock on some of this data. So these are products that are absolutely in need right now. You know, innovation is happening at other levels as well. I mentioned Ecolabs and what they're doing at the sanitation side and saving water with more advanced water chemistry. It's true breathtaking innovation in a boring subsegment, but you've got, like I said, you've got pricing power, and you've got customers that are forced to kind of pay up and sign longer-term contracts for this advanced technology. I mentioned, UPS and what they have done, shifting from B2B to B2C. It's unbelievable. Again, it took them $10 billion to do it, and potentially new leadership, right? You've got Carol Tomé, who was the ex-CFO of Home Depot, crossing the street in Atlanta to Home Depot, but she has done in a short amount of time an amazing job. But there's a company with a huge amount of technology and innovation when you think about density and a footprint that frankly can't be matched on a global scale with pricing power, right? These are things that you're going to get paid for. So that's almost the starting place for underwriting a new position, is just the ability to extract technology and leverage it.
When thinking about the exposures that you have in the strategy, which set of names do you think is most directly leveraged to a post-vaccine world?
Yeah, I think we've kind of covered a lot of that. I'd take it one step further and call it, almost just a post-COVID world, right? I mean, again, our base understanding is we're going to have some version of a successful vaccine, and it's hard to not have that as your base view, or else you can get really negative, and that's not how we're positioning or see the world. I mentioned that work from home has an awful lot of permanence to it. It works for most people. Consumer behaviors are going to change forever, and that's going to be durable as well. Real estate migrations, as I mentioned. I went through a huge list, right? Uber, Raytheon's business has gotten gutted because of the commercial aero exposure, and there's a company, if you look at the aftermarket for both Airbus and Boeing, where it's, like I said, it's been very maligned. If you squint, right, you can see how a company like that can grow cash flow and earnings, albeit off a low base, 20% for the next 5 or 10 years, as you see flight cycles, right, which are takeoffs and landings, as well as flight hours increase, right? Engines need overhauls, they need maintenance, things break. So there's a company that should reemerge in a much better place. And again, where are you going to get 20% earnings growth? I could tell you where you're probably not going to get it, and it's in a lot of the names that have been exceptional performers to date, right? You're going to have to start looking elsewhere to get that kind of earnings growth. So Ulta, again, another name that has had all their stores close, and in the reopening they got smarter, right? This omni-channel and curbside pickup, their online offering is up 100%, right? They're forced to change as well, and they're going to be a survivor as especially retail is going to get smoked. And so we're trying to pick our favorites there, and then Disney is obviously one of those as well, which is it's going to be a longer probably slog for Disney. Just given their huge exposure to a heavy asset in parks and cruise lines, but they've got a set of assets that are unmatched in terms of their internal animation IP, and they've got a long runway of growth. It's going to be a little bit choppier there.
Thanks, Peter. You mentioned Costco earlier. It's a company that employs a subscription model. Can you touch on a few other examples of companies in the portfolio that have a recurring revenue stream? Sure.
So I think we can all appreciate the Costco business model. Just to finish that point, right? Here's a company that effectively sells goods at negative gross margin, so you can't undercut them, but you keep drawing people into the store, right, because of that treasure-seeking mission, and it's a company that has done an unbelievable job, and it's one of the great business models. Amazon with Prime, it's a subscription business with in excess of 100 million people, probably growing 15% per annum, and they've been a COVID beneficiary. So there's a very, very good business, and Prime customers spend somewhere in the neighborhood of 8 to times that of a non-prime member. The kind of traditional software, so guys like Salesforce.com and Adobe and Microsoft, clear winners or heavy exposure to the subscription basis. There's a lot of companies trying to get there, change their financial model. Whether it's Splunk or Palo Alto, have a little bit more kind of predictability in their cash flow. I mentioned Ecolabs, right, which is a consumer and industrial manufacturer of water chemistry and others. Most of their customers are on some version of subscription with price escalators. So there's quite a few companies in the portfolio, and as I mentioned before, you're going to, generally speaking, pay a higher multiple for that more predictable revenue stream of subscription.
Thank you. One question that keeps coming up is the biggest risk over the next 12 months. Is there an area where you think that risk is most under discounted today? And also, how would you contrast that risk over the next 12 months with your longer term view over the next 3 to 5 years, given the backdrop set forth by the interest rate world?
The risk is I don't even know where to start. I mean, the risks are enormous, right? You've got policy risk, right? The knuckleheads in Congress and the political infighting. That's a huge risk. It always has. The Fed not managing their dual mandate, which arguably I think they've lost control of anyway. But if they lose control of inflation and let it run hotter, you can wreck the equity market pretty quickly. I mentioned earlier just valuations in general. And this market is so overbought at every single level, and just the sheer gravity, right? Just the weight of expensive valuation is a risk in itself, and that's oftentimes going to be at the single stock level. But as a market, right? I mentioned, which is interesting, is the 10 years gone from, call it 55 bips to 80. If for whatever reason, and I am not a credit guy, but for whatever reason, if you see rates at a percent and a quarter, and you're scratching your head as to why, right? Is it FX? Is it inflation? It's got large effects on DCFs of equities, right? What's it going to do to the mortgage market, which is very, very sensitive to rates, even absolute low rates. So there's I think again the level of risk is extremely high, and I mentioned before, underappreciated as measured by the VIX, credit, generally speaking, credit default swaps. There will be bankruptcies, and there's going to be a lot of them when the fiscal kind of hangover wears off, right? Everyone's had a kind of a small taste of socialism with getting money directly injected into your banking account. At some point, that's going to wear off, and there's going to be an awful lot of pain and suffering, unfortunately. In a world where the Fed and the Treasury can't control everything, and so there's another risk of structural unemployment, and we just haven't seen that. So I don't want to end the conversation on that. It's all things that we're aware of, but blind faith and almost a religious following of the Fed, could end in tears if they don't, and policymakers as well if they don't do their job.
If any of those risks materialize, or we see that broadening out or shift in leadership that you mentioned at the beginning of the call, would that reward the way the portfolio is actively positioned?
It should. It has. When we get these mini spells over the last 6 months, the portfolio has done exactly how it's designed, and it's not just held up. It's outperformed dramatically as equities have kind of leadership has been redistributed. So that's the way we're set up. We're still set up for very low growth. We have been for a decade. It's been the right call. We need to be aware that fiscal stimulus is not stimulus. right? It's a Band-Aid, and there's no accelerant from dumping money into the system from here. It will wear off, and we're going to be back to price discovery and what a normal economy should look like, and you're going to get rid of the distortions, and this is usually a period where this product does very well. When I say this product, I'm just saying just the balanced, risk-aware nature of portfolio construction, but still having a level of concentration that should allow our type of strategy to outperform through the cycle.
Thank you, Peter. And I want to thank everyone again for joining in the call today. It's been a pleasure to share with you our third quarter update for ClearBridge Large Cap Growth. Please, if you have any follow-up questions, don't hesitate to reach out to either your ClearBridge or your Franklin Templeton contacts. The call has now ended. You may disconnect. Quick housekeeping items. The slides will be available. We should send those out to you. And this session has been recorded. Thanks, everyone. Goodbye.